There has been a number of bonds that are guaranteed by the CGIF, for example, Sabana in Singapore that you mentioned earlier, and then in Malaysia there is also Hektar REIT, and also I think another steel company in Indonesia. So why do investors buy bonds that are credit guaranteed?
I think it's a question of ratings, and it's a question of the return also for the rating which they're getting. We've been working very hard with investors to explain to them our processes in terms of how we assess companies and how much effort we put into monitoring our portfolio. And we are very proud about this, that our risk management and our monitoring of our portfolio is extremely strong. For a pure play credit player like us, which has done $3.5 billion of guarantees, we've only had one case of default, which was for 80 million. That's a very low percentage. And I think that low percentage shows that we are very selective in the companies we take up. And even after we take up, if we see problems, and I'm not saying in our portfolio there are no problems, we manage those problems very actively with the issuers to ensure that the investors do not suffer or do not have any heartburn. That's one. So I think there is some credibility of CGI's processes. The second thing is that we've been working very hard to explain to investors in certain markets like say Indonesia or Thailand or Vietnam about how we would support if there's a non-payment event happens on any of the bonds which have been issued. And that has given investors a lot of confidence. So more often than not, we've seen our recent deals have all been oversubscribed. I wouldn't say this was the case some years back. There was a lack of understanding. We've had deals which have been undersubscribed. We've had deals where subscription has been an issue. In other markets, we took a step back. We had a very strong investor outreach, did a mapping of the investor ecosystem, and we targeted each and every investor with questions as to why not CGIF, and when we had that bilateral discussion, it was able to generate that confidence in those investors to invest in CGIF guaranteed paper. I think this has to be a continued effort from our side. We can't drop the ball. Initially, when we started off, a lot of our marketing of CGIF guaranteed bonds was left onto the financial arrangers and was very deal specific, but now we've become more communicative on a regular basis whether there's a deal or not. So I think that helps a lot. Our underlying credit strength is there. We've got close to $1.35 billion of investments. When I say dollars, it's hard cash with us. Unlike a lot of other guarantee institutions and MDBs which work on capital commitments, we have $1.3 billion of cash. On that 1.3, our leverage ratio is just 1.1. So we are very underlevered. We can go up to close to 4 billion on our portfolio, but our portfolio currently stands at about 2 billion, 2.3 I think as of latest standing. We maintain a very conservative stance of growth. We only want to do deals which are catalytic, which are statement making in the system, and we really don't have very aggressive targets to be actually making money off this business. We really want to be entering the market and getting more confidence between issuers and investors coming in. So that's what we are doing.
The 1.1 that you mentioned is the portfolio value to your capital? Or?
Correct, it's the net value. We also have risk sharing agreements with certain partners. So we have a reinsurance panel out of reinsurers in Europe. Whatever we originate, 25% automatically cedes to them. So that's actually, our capacity gets enhanced by that. So even though our capital is 1.35 and we have our portfolio would stand at about 2.3 today, our net leverage ratio is around 1.1. So it's capital into 1.1 times is our net risk after all the risk sharing we've done. We do risk sharing with banks. Like there are certain deals we've asked OCBC to come and be a risk partner with us. We've had deals where Korea Exim has been a risk partner with us. So yeah, we are very open to people coming and working in partnership with us. So CGI fronts the deal and then we sign back-to-back risk sharing. So that gives us a capital relief on the portfolio.
So CGIF has been around for about 15 years. Do you see an evolution in the type of investors that come into these deals?
Yes. I think it's been a learning exercise for us. When CGI first started guaranteeing bonds, the only investors which would come in and were usually institutional investors and more of the insurance companies and asset managers which had a global outlook, which were the, or let me call it the multinational asset managers and insurance companies, not as much the local ones. And we saw that our deals were not as diversely distributed through the capital market ecosystem. And I think as a market development agency, we need to ensure that the the process of people buying into CGIF bonds should be more democratized and should be more widespread, where we need some HNIs coming in, we need even retail coming in sometimes, we need the local insurance companies and local private funds coming in. And I'll just take you through a story in Indonesia, like that we had cases where our bonds would be undersubscribed. Till 2021, all our deals in Indonesia, but either they were offshore, so Astra Sadaya Finance, Portal Indo, they issued in Singapore dollars, so not being issued in the Indonesian markets, or they were issued in IDR, but they would be invested by offshore investors. So like a Japanese investor would go and issue the full paper issued in IDR because they need diversification of currency at their side. But there was no deal issued for the benefit of local Indonesian investors. So in 2021, we took a step back and said, this deal which we are doing, we wanted to go out to the local investors. It was a $50 million issuance. It was undersubscribed. We only got 43 million of bids, and we were very surprised. The financial arranger was very surprised as to why the local state-owned funds, the local pension funds did not invest in this. And that's when we got to know that they didn't invest in it because they didn't know CGIF that well. They did not know how an entity, which is a trust fund of ADB, and they didn't know what a trust fund meant. They did not know how the guarantee structure was different from other guarantees. And I think the fault was ours. It was not theirs. And I think fault was clearly ours that our market outreach at that point in time was not that strong. We had never had these bilateral communications with these people. And that's when we took a step back and said, let's stop doing any issuance in Indonesia till we work on getting the investor side right. We've done that now. So we've now got to a situation where every large investor in Indonesia knows us. They ask us when the new bonds are coming in, and the market supported us because when dollar interest rate went up, access of large Indonesian corporates to dollar funding went down. So they were all looking at IDR solutions. So we were lucky from that point of view. So the market supported us. Our efforts were made on the investor side, and that kind of confidence of our regular interaction with them has really helped. And now all our deals are getting oversubscribed in Indonesia. So that's how we worked. And that's how we'd like to keep working. Getting issuers is one thing, but I think CGIF as an institution needs to be very communicative and very open in discussing not only good cases, but also if there's a default which happens in Thailand, we talk about it to investors in Indonesia as to how we've handled it.
I see. So they learn from your experience in other...
They learn, and we tell them, this is what we did, this is how the timing went, this is how the investors are paid off. If it happens, we do the same thing here. So we need to be communicative, because if you want the bond market ecosystem to go, you cannot be opaque. You need to be absolutely transparent with what's going on. And that's what we're doing as an institution these days.
So if I'm a bond investor, most likely I will be looking at the standalone credit profile of the underlying. But on top of that, of course, CGIF's credit strength becomes very important for that particular instrument. So maybe can you share with us a bit more about your credit underwriting process?
Yeah, so our credit underwriting process is very strict. Like I said, we do not go after companies which are rated below BB minus. We do not go after companies which have had any kind of recent restructuring history. If they've had any kind of debt which has been restructured, if they have any delays in their, if they're having delays in paying the normal banking facilities, we will not deal with those companies.
Even in the past, maybe this is something like 10 years ago?
Yeah, we will not. That's why if you see our portfolio has been very robust, because we are very particular about who we deal with. We also as the institution believe that when we look at integrity risk, we also look at the behavior of the issuers. If they've had past issues of defaults, they could be a very strong balance sheet now. We would be very wary of dealing with them. So that's something we are very careful about. So at the end of the day, we are managing public money. It's money which is taxpayers' money which the governments have given us. That kind of oversight is very important for us to maintain. I'm not saying we should be absolutely risk averse, but I think we should be very informed about the risk we are taking. That's one thing we do. So our due diligence is very robust. A lot of investors talk about ESG these days. I can assure the investors that if CGIF has done the deal, the ESG risk is not an issue, because we've been doing it for years. Our environment social safeguard deals are extremely onerous. There have been cases where there are certain investors where we are open to even talk about what issues we encountered on the ESG side and how we countered them while we are doing the deal. So that's how open we are as an organization now with investors. If an investor comes and tells me that I have issues with the credit or I have issues with the ESG side, how does CGIF get comfortable? we as an institution are so open that we will have a bilateral discussion with that particular investor, even if they're investing $1 million out of a $200 million deal, because we don't want them to have any doubts before they come in. And we have given this carte blanche to all our financial arrangers that if you have any investor who asks you questions, bring them straight to us. We will tell them how we got the comfort and how our analysis was done. So we are very open on that front. The one thing which also investors get as compared when they do invest in CGIF guaranteed bonds, when investors look at the underlying credit, which is the issuer's credit, and then they overlay the guarantee on top of it, our bonds are slightly sweeter in terms of spread as compared to other AA bonds in the system. So I think investors not only get a good deal, but at a slightly better rate as compared to what they get from a regular AA issuer. So I think that also is a very important factor which investors like. And this is across all markets, whether it's Singapore, Indonesia, Thailand, Vietnam, the spread is always slightly sweeter than where a normal AA would be.